Okay, so welcome to this is day 3 of the CTA Accelerator Bootcamp program. So what we'll be doing over here is so tonight we're going to be doing, this is the third class for FAC1, FAC3, and what we'll be doing is part B. So if I just go to the required to show you what we'll be doing tonight. So here we have part B, disclose the following categories of assets. So disclose the following categories of assets. What are the categories? Land, buildings, plant. For the plant cash generating unit only. So that's important for the plant cash generating unit only. In the notes to the financial statements for the year ended 28 February 2019 in terms of IAS 1673D and E. So as you can see, if you don't have your book on that day, how are you going to know what is paragraph D and E? So it's important that you actually have your handbook with you, because if they're going to give you that 16.73 D and E, if you didn't work through the book, if you didn't memorize the book, you're not going to know what that is. So most of us don't memorize it, right? So that is why it's important. So you quickly go to 1673 D and E, and you'll see what it is. When you read through it, you will see it is basically the PPE recon note. Okay, so it's very important to make sure you have the book, but they're not telling you exact in words what they want. They're telling you in terms of the standard. So then if you don't have the standard with you, so if I must not have my book with me, I wouldn't know what is 16.73 D and E. I need to look at my handbook and see what that paragraphs are about. So that's important. So the second thing that's important is the date, 28 February 2019. So that means the current year is 28 February 2019 and the prior year is 28 February 2018. But they're telling us comparatives are not required. So that means we only need the 2019 financial year. The other important aspect, the only one for the plant cash generating unit. Okay, so it's only for the plant cash generating unit and not all the assets, only these 3 assets. Because take note, in the plant cash generating unit, the assets in the plant cash generating unit is land, buildings, plant, inventory, and trade receivables. These are all assets, but they only asked us for these 3 assets. And remember, it is only these 3 assets that actually fall under IAS 16. Inventory does not fall under IAS 16. Inventory falls under IAS 2. Trade receivables don't fall under IAS 16. Trade receivables fall under financial instruments, IFRS 9. Okay, so if I didn't tell you these 3, if I just said prepare the note IAS 1673 D and E for all the assets within that standard, then you must know it is only these 3 assets. Okay, inventory does not fall under IAS 16. Trade receivables don't fall under IAS 16. Okay, so that's very important to take note. And how do we know that this is the cash generating unit of the plant? Was it telling you? It was identified that the following group of assets relates to the operation of the plant and is largely independent of the cash inflows from other assets in the business. So these assets over here are the assets that forms part of the plant's cash generating unit. Okay, so it's important to understand what the required is asking. So train yourself how to read the required so that you don't spend 3 minutes reading a required. That as you read a required within your 10 or whatever 10 seconds, you pick up the important aspects. Okay, so train yourself to read the required properly. Okay, so now we're going to go and deal with this cash generating unit. We're most likely going to have to read some of the important aspects again. But most likely we're going to just read through the various notes. Okay, so Let's start working through this plot. Okay, so I'm going to stop this and I want to share my Google Sheets. So let's go through this. So we're going to deal with, let's start with land. We'll just start as we go through the notes, okay? Okay, so remember under note, so if you look under the table, you can see we have land, buildings, and it's telling us to refer to note number 1. Okay, so let's look at note number 1. So land and building. So they say property A consists of land and a building. This property is adjacent to Cable's current premises, property B, and was acquired on 1 March 2016. Cable has been leasing property A to a tenant since the company relocated its own business operations to property B on 28 February 2017. Okay, so now you can see from 28 February 2017. Remember, we are doing the note for the 28th February 2019 financial year. So that means the start is 1 March 2018 to 28 February 2019. So in a prior period, from 28 February 2017, we relocated to property B. So basically from 1 March 2017, property A was leased. So from 1 March 2017, property A was an investment property. Remember the key issue with investment property, what makes an asset investment property? Number 1, it is a fixed structure like land and buildings. Number 2, it is held to earn rental income, or it is held to earn to obtain capital appreciation. Okay, so if you're holding a fixed structure to earn rental income, if you're holding a fixed structure to earn for capital appreciation, then it is investment property. So a fixed structure is it's like a very it's quite hazy kind of thing. It is so it's generally going to be land and buildings. And it's like, for example, like I know one of the lecturers once explained, because he's now part of Psych's technical thing, right? So he's part of those people that works through the Psych handbooks that we are doing. He left UCT and he's now working for the ISB. So he's quite technical, and he explained that when the ISB discuss what is a fixed structure, it's, it's like they're going to quite detail. And he had the opportunity to lecture, like obviously GDA. So UCT have like 2 programs for GDA. One program is where you go from first year, second year, third year, and you're going to GDA. So your full career is basically, or your full study period is, you want to become a CA. The second option is it's someone that did a postgrad, and then you can do a 1-year bridging course to do the GDA, right? So in that class, in the 1-year GDA program class at UCT ran, one of the students he lectured came from the architecture faculty, okay, or department, and he did his 1-year GDA thing. And then he explained from architecture point of view, a fixed structure is considered, they consider something to be a fixed structure if it have a roof. Okay, so, and that is one of the discussions that the ISB has. Must it have a roof? Must it not have a roof? This, that, is a fixed structure something that cannot move? You know, it's all of these type of things. But anyway, why this is important? Because a topical issue regarding fixed structure and a topical issue regarding fixed structure and investment properties is the issue of the fixed structures that mobile operators have. So for example, Vodacom, not Vodacom, Vodacom, MTN, and Cell C, and all of those kind of guys, in order for them to have network, right, they basically take their thing, whatever it is, the satellite type thing, and they attach it to some structure, right? And these structures are not actually owned by them in most cases, it's owned by other companies. So the question is, how does those companies classify those structures? Is it PPE? Is it investment property? Because now the issue is those companies have these structures to earn rental income, because in order for Vodacom, in order for MTN to attach their satellites to this fixed structure, they pay a monthly or annual fee. So they pay a rental fee to these other companies. So the question was, so this is held for rental income. So is it investment property? Is it PPE? The only time it can be investment property if it is a fixed structure, which typically is land and buildings. So the conclusion was that this stuff is a fixed structure and must be treated as investment property. So I know I came across it also in a UNISA paper sometime. So it was quite a topical issue at that point in time. So for CTA level 2 guys, just read investment property regarding the whole issue. What makes something investment property, and carefully read the issue regarding fixed structures and land and buildings and stuff. Just like it's one page with different, it's like I think one or two pages that you need to read quick, but this, in about 2 or 3 of those paragraphs, there are very important concepts that get tested. Okay, so just make sure you read that. It's at the beginning of investment property. When you open up the standard, like really, I think after, so you get objective, you're going to get scope, you're going to get definitions, because it's IS40 is the old standard, and then you'll get, so then they'll discuss, I think the heading is called land and buildings, what's called fixed structures, or something like that. Make sure you read that, because discussion questions for investment property literally come from there. So if you read that paragraphs, when that comes up, you're going to be aware of those paragraphs. So all you're going to have to do is open up your book and go to those paragraphs when you write, when you explain your discussion. So don't underestimate. That is where they make investment property challenging, is what makes this thing investment property. Okay, so just be aware of that. So in this case, from 28 February 2017, from 28 February 2017, so when something is land and buildings, and you're holding it to earn rental income, or you're holding it to earn capital appreciation, then it's investment property. Okay, so just be aware of that. So from 28 February 2017, you have investment property. Then they say a revaluation surplus amounting to 50,000 Rand was recognized on the land of property A on 28 February 2017. Okay, so on 28 February 2017, there was a revaluation surplus amounting to 50,000 Rand that was recognized. Okay, when Cable A commenced with the leasing of property A to the tenant. To this date, this is the only revaluation which Cable has performed on land. Okay, so what they're trying to say over here, property A was first used as PPE. Okay, so property A was first used as PPE because Cable used to use that for the operations. When they moved or relocated to property B, they no longer needed to use property A and they started leasing property A. So that means on 28 February 2017, property A went from PPE to investment property. Okay, so take note of that. So because of that, when it went from PPE to investment property, you first need to, when you do that transfer, you first need to recognize the asset in terms of the original standard. So the original standard was PPE. So on 28 February 2017, before they transfer from PPE to investment property, you first account for the asset in terms of its original standard, which is PPE. And because they use a revaluation model, they needed to do a revaluation gain or loss. So here they say there was a revaluation surplus amounting to 50,000 Rand that was recognized on property A on 28 February 2017. So I'm going to make up a number. So let's say before 28 February 2017, let's say I'm assuming a revaluation surplus was an increase, but we will look at the details now below. But let's just say the asset was 1.5 million before 28 February 2017. Now on 28 February 2017, they transferred into investment property. But before they transfer to investment property, they first need to apply IAS 16 in its fullest. So they're using the revaluation model. So let's assume we went from 1.5 to 1.550. So the journal entry would have been debit land 50,000 Rand, credit revaluation gain OCI 50,000 Rand. Okay. So now the property is no longer 1.5, it is now 1,550,000 Rand. So when they now transfer from land and buildings to investment property, they're going to say debit investment property SFP 1,550,000 and credit land and buildings PPE 1,550,000. Okay, so just take note of that. So that is what this 50,000 Rand is all about. This all happened on 28 February 2017. So they say, since Cable planned to utilize property A as the premises for the new HDCW plant, the tenant was given an official notification to vacate the premise on 30th June 2018. Okay, so on 30th June 2018, which is in the current financial year, the current tenant needs to vacate. So now, as at 30th June 2018, we're going from investment property back to PPE. So before we transfer from investment property to PPE, we need to account for the property in terms of IAS 40 investment properties up until 30th June 2018. So as we read the scenario a few days ago, we know investment property is accounted for in terms of the fair value model. So therefore, we need to do a fair value adjustment as at 30th June 2018. And then from there, from 30th June 2018, we will then account for the land and buildings in terms of PPE. So what is important to take note, the fair value in terms of IAS 40 now becomes the new cost price for the land and buildings for PPE purposes. Okay, so just be aware of that. So they say the following information relates to property A. So here, accounting method according to IAS 16, property, plant and equipment. So for land, they use a revaluation model. For buildings, they use the cost model. Okay, that is for PPE purposes. Useful life, land is always unlimited unless it's a specific piece of land like a mine. And building is 20 years. Depreciation, not applicable. You do not depreciate land. Please be aware of that. Unless it's a specific piece of land, like a mining company, they only have the land for a specific point, for a specific period of time. Other than that, you don't depreciate. And then here we use the straight line method over its useful life. Residual value, there will be nothing. And here it is 280,000. So carrying amount 1 March 2017, 1750. Carrying amount, carrying value 1 March 2018, it is 1750. Okay, so just be aware of that. And then for the building, 2.4 and 2.4, fair value 2.4. Okay, so just be aware of that. So remember, for property A's purposes, okay, so for property A's purposes, it is important to understand what is our opening balance. Remember, we're only getting these assets in the current financial year. So in the, these assets are only becoming PPE in the current financial year. So that is why land and buildings for property A in terms of PPE will be 0. Okay, so land will be 0 over here. Buildings will be 0 over here. We won't have depreciation for land because there's no depreciation on land, and buildings will be 0 because we did not have the land and the buildings we had always, but it was not classified as PPE as of the beginning of the current year. It only became PPE during the financial year as at 30th June 2018. Okay, so just take note of that. Okay, so we're okay with that. And remember, for plant, there's also no opening balance. Why? We only we only decided to acquire the plant in the current financial year. So therefore, the opening balances are all 0. Okay, so just be aware of that. So, so it's very important to take note and don't make a mistake that some would make. And the mistake that some would make is that they would use the opening balances that they gave us in that table, not realizing that those balances is correct, but it wasn't, at that point in time, our land and buildings was not PPE. At that point in time, our land and buildings for property A was investment property. And this year is a PPE note. Okay, so please be aware of that. So that's why it's very important to understand what you are actually trying to achieve, okay? And that's why it's always important when you're dealing with assets to always keep in mind the classification, okay? So what is this asset at this point in time? Because remember, like land and buildings or property can be investment property, it can be PPE, it can be inventory. It all depends on what is the purpose of the asset at that point in time. So before 30th June 2018, the property was held for rental purposes. So that made it investment property. From 30th June 2018, the property is being used for our operations. So it's owner occupied. Therefore, it makes it PPE. If this building if we were in the business of buying and selling property, then this property would have been inventory. But because we are not buying in the business of buying and selling property, it can't be inventory because it's not, we don't buy and sell in the normal course of business. Okay, so it's very important to always keep in mind the classification. Okay. So let's continue. Let me just see what else do we have over here. Okay. So before we continue now, we have the opening balances. So what I want you to do, and I'm going to give you about 10 minutes from now till 25 past 8. If you can get me, so here you can see the plant, the cost price, they say refer above. So remember, refer above was that table with all the costs. Let me just go see quickly where that was. Yeah, so under HDCW plant, read that and try to determine the cost price for me. So the cost price, because remember, the cost price is going to be our addition. Okay, so the cost price is going to be our addition. We acquired a plant, but remember that price of that plant or the amount for the plant will include all costs incurred to bring the plant to a place and condition ready to be used. It's not only going to be the purchase price, but every other cost to bring the plant to a place and condition ready to be used. I'm going to give you about 10 minutes to work through that, and then I will work through it with you. Then you can compare your answer with mine. And in that way, you'll be able to ask me any questions based on any differences that we may have. Okay, so I'm going to give you 10 minutes. In about 10 minutes time, I'm going to come back and then we're gonna work through it. Are you guys done? Or do you want a few more minutes?
A few more, please.
Okay. I'm gonna give you guys 2 more minutes and then we need to get going. Okay. So 2 more minutes and then I'm gonna start.
Hi, Faiz. In case you're talking, you're on mute, or at least I can't hear anything.
Oh my word, I was talking all the time and I was on mute all the time. Um, oh, I said such a lot of things. So let's see what I need to say again that I was saying. Thank you. I have been here all day explaining and you hear absolutely nothing. Um, so um, I was saying quite a bit of stuff now. What did I say? Let me just rethink what I was saying. Okay, so I was saying that, yeah, I'm doing the workings on this tab and I'll put the answer in over there. So I was also saying that we're dealing with, um, we are dealing with the cost of the item. So what's important to take note is that the cost of the item, it is all costs incurred to bring the item to a place and condition ready to be used. The item, the plant was ready for use on 31 August 2018. So it's all costs incurred to bring the item to a place and condition ready to be used as at 31 August 2018, because that was the date when the item was ready in terms according to management. Then I went on and I said that the way I would list my items over here is based on how the scenario is formatted. Okay, so I start with a scenario and I read from the scenario and I will pick up items based on the order of the scenario. So for example, the first thing I come across is borrowing costs. So when I see borrowing costs, I ask myself the question, should borrowing costs be included in the cost of the item? And as we know, borrowing costs is capitalized, is included in the cost of the item. So it was the first amount I came across and I plugged that in. Then the next amount items were the list, okay, that table, which gave us the payment to supplier and all of those type of stuff. So now I go with that. So I was also saying that in the scenario, in the solution, they most likely started with payment and all of those type of things because they exactly know what needs to be included. But I'm under exam pressure. I have no time to follow a particular order. There's no need to follow a particular order, but it's just a calculation. So I go in terms of the order of the scenario. So the first cost that I came across was borrowing costs. That is why I put borrowing costs number one. Then next in line, I had these items over here. I also said that you don't have to write the full name for each per the scenario, but it needs to be something that is clear which line item you're referring to. Okay, so just take note of that. So then I wrote all of these. Now I'm doing the calculation. Okay, so for payment to supplier, I'm going to have a working. The reason why I'm going to have a working is for the payment to supplier is that we acquired the item on 15 July. The payment is going to be made 15 November, which is in 4 months' time. In 4 months' time, and then the normal credit terms is 30 days. So the normal credit terms is 1 month, but I'm only making payment in 4 months' time. So therefore, I need to discount this amount. So in terms of financial reporting, when an amount is beyond normal credit terms, you have to use a discounted amount. Okay, and this, what you must know, this discounting is big. Okay, so in the real world. So in every audit, they're going to check for discounting. Every single year, we're going to try to find a reason why discounting is not required because it is immaterial. Okay, so just take note of that. So like for example, in one of the companies, when I was a financial accountant, we made sure, one of the reasons we made sure our debtors book was clean. Well, obviously from a business point of view, you want it clean because you want to make sure you're receiving all your money, because there's no point making sales but then you don't collect the cash, because in the end you will just lose out. Okay, and remember cash is more important than actual revenue. But another reason for making sure our debtors book was clean, because when it's beyond 90 days or beyond your normal credit terms, then auditors wants to do discounting. And then besides the fact that you know it is immaterial, it still needs to be proven that it's immaterial. So then we need to provide them with a calculation from our side so that they can test it. Now, we don't want that extra work of doing a discounting. So discounting is it's like important within the audit world. So, and obviously as a financial accountant, you also need to comply with IFRS. So then you also need to make sure you do discounting. So in order to avoid discounting and just to have good business practice, we made sure our debtors book was clean. And the way we made sure our debtors book was clean is that we're receiving our cash within our payment terms. So from a financial reporting point of view, whenever something is beyond normal credit terms, what you must be on the lookout for is the issue of discounting. Okay, it's a very important thing in financial accounting. It's very topical from an audit perspective as well. Okay, so this payment is paid in 4 months' time, so therefore it is beyond normal credit terms, so we need to do discounting. Discounting implies we need a present value. So that means in order to calculate present value, we need everything else. So we need future value, we need payment, we need N, and we need I. Future value is the lump sum payment at the end of the period. So in this scenario, it is a lump sum payment at the end of 4 months, which was given to us as 4651885. 4651885.44. Okay, so it was given to us. PMT is your fixed regular payment. There is no fixed regular payment for this, so therefore it is 0. N is the remaining number of payment periods. So how many payment periods are there? So remember, or how many compounding periods are there? So this question is about monthly compounding. So because it's monthly compounding, the remaining time frame is 4 months. So therefore N is 4. The discount rate must be, so the discount rate is your pre-tax discount rate. The pre-tax discount rate was given to us as 10%. But remember, that's 10% per annum. Our I must match our N. Our N is a monthly compounding period. So therefore, I must also be a monthly interest rate. So all we're going to do, we're going to say 10% divided by 12. Okay, for Excel, we need this to be percentage. Okay, so now we're going to plug it in. So PV, so equal present value, open bracket, I in PMT future value. In Excel as well as Google Sheets, you need to state whether it's the beginning of the period or the end of the period. Okay, so this is paid at the end of the period. So when you have it end of the period, Google Sheets wants 0. If it is the beginning of the period, Google Sheets and Excel want you to put in the number 1 so that they can know. So what's important for your purpose in your financial calculator is default on end of period. If you want it to be at the beginning of the period, you need to adjust your financial calculator. Okay, so just take note. So there we go. So the cost, so the present value, the discounted amount is 4.5 million. Remember, the way the formula works is going to come out to negative, but we know that needs to be positive. Okay, so just be aware of that. Okay, so there is working 2. Now we're going to do transport to factory. The transport to the factory is 15,191. 15,191. External cost to engineers is at 61K, 61,438. 61,438. These are all given, okay? So there's no need to put the word given. Installation for remuneration. So it was given to us as 26,000, but remember, 2 of our 20 employees are administrative. So therefore, we only need to account for 18. So this is going to be 18. This is going to be 26,000 multiplied by 18 divided by 20. Okay, because only the other is administrative, so can't form part of the cost of PPE. So we can say 26, 1, 2, 3 multiplied by 18 divided by 20. Okay, so that is that cost. Then we need to do provision for dismantle, working 3. So the provision for dismantle, they're telling us future cost to dismantle the plant after its useful life. After its useful life is 750. Okay. So once again, we're going to need a present value. So once again, we're going to need present value. So the future value is the lump sum payment at the end of the period, in this case, 20 years. So what is that now? 750, 1, 2, 3. PMT is a fixed regular payment. There's no fixed regular payment, so it is 0. N is the number of periods. Okay, so let me just check something here quickly. Okay, so here just working in years, so there's no need. Let me just quickly see the discount rate. If you go to the discount rate, it was 10%. Where was that discount rate now? And additional information, the discount rate was given to us as 10%, I think, compounded monthly. Okay, so that is why we need to convert. Okay. So once again, N is 20 years. But remember, N is the remaining number of compounding periods, or the remaining number of years, or the remaining number of payment periods. There's no payments, so we talk about compounding periods. So therefore, it is it's the compounding period is monthly, and the number of years is 20. So all we're going to say, it is 20 years, number of years is 20 multiplied by the number of compounding periods, or the number of payment periods. In this case, it's compounding periods. So the number of compounding periods is 12. It's 12 number of compounding periods per year. So it is 12 per year because it is monthly. So therefore, it is 240. Okay. And then I is going to be 10% divided by 12. Okay, so there we go. Now we can work out present value. Once again, PV open, they want I, they want N, they want PMT, they want future value, then they want end or beginning. So it's N, so it's 0, and so that will be 102. So go plug in this is C17. So I'll go plug in, and we're going to have equal C17. Needs to be negative because we want a positive number. Okay, so that would be C17. Okay, so that is those amounts over there. Next, there's still some more information below that table of information. So they say, as part of the commissioning of the plant, the engineers tested the functioning of the plant at a cost of 18,500. So that is testing. Okay, the quality wire produced during this time satisfied the requirements specified by the engineers, and the plant was signed off by the engineers on 31 August 2018. On this date, management was pleased that the plant will function as required and commenced with the production thereafter. Okay, so that's why 31 August is ready for use, or 1 September ready for use. The wire that was produced during the testing cycle was sold to local entrepreneurs at a total price of 8,000. Cable donated these proceeds towards a children's hospital in their vicinity. Okay, so just take note of that. So now here we're gonna have testing. The testing is 18,000 Rand, but because we made some money off the testing, we must reduce the testing cost by the proceeds. So therefore the cost was 18,000, but as it is for the testing, but as a result of the testing, we produced wire and we sold the wire for 8,000. So the testing needs to be net of the proceeds as a result of testing. Okay, so this is going to be 18,000 minus 8,000. Okay, so that's important to take note. Okay, so just be aware of that. Don't lose that easy mark. Testing reduces the cost. Proceeds from the testing reduces the testing costs. Okay. Okay, the plant requires an inspection every 2 years. At initial recognition, it was estimated that the first inspection costs will amount to 60,000 Rand. Okay. Okay, so this was this was basically the inspection. So including the inspection is at 60,000 Rand. Okay, so that we will deal with just now. So they say on 1 August 2018, Cable acquired safety equipment for plant, which amounted to 185 from a nearby supplier. On that date, Cable also acquired spare parts amounting to 125 from the same supplier. 25% of these spare parts relate to minor replacement parts, such as valves and screws. Okay, safety equipment and spare parts, which is categorized as plant and equipment, will be utilized over 6 years. Okay, so we have spare parts. We have safety equipment and we have spare parts. Okay, so that must also be included in the cost. You can either have it separately or you can include it. Okay, so we can either include it or we can have it separate. You can either have a separate category for spare parts or you can include it in the normal cost. So it's I don't know how UNISA usually would do it. You just see what they would usually do. That's going to get an amount before spare parts. So it depends. So remember, there's no right or wrong. It all depends on what the company wants to do. So you can either include, let me just do this quickly. Okay, so this is cost before spare parts. Okay, now we're going to include spare parts. So what you can do, so here's one of two ways, right? Spare parts will either be its own category of PPE, or you can include it in this thing over here. So I guess what you can do, the way you'll pick it up is as follows. If there's no separate category, so over here, there is no separate category of spare parts. Okay, then you just include it in the particular item. So because there's no separate category.
Sorry. I just wanted to ask about the testing. I see you wrote 18,000. What wasn't it? 18,500.
Oh, sorry. Thank you.
Yeah.
18,000. 18,500. So this must be 18,500. Okay. Okay, so there we go. So with spare parts, you can either have a separate category for spare parts, or you can include it over there. Okay, so if you pick up different financial statements, some companies will have a category for spare parts. Okay, so here they don't have a separate category for spare parts, so then it's okay to include spare parts over here, because the spare parts relate specifically to the plant, so it's okay to include it. When you have spare parts relating to different assets, then it's probably best to have a separate category called spare parts. But because this spare parts specifically relate to the plant, it is okay to include it in the cost of the plant. Okay, so just be aware of that. Nothing major, nothing to have sleepless nights about. Okay, so just be aware of that. So here we're gonna have, there was two types over here. There was, what was it? Safety equipment. And then there was, what was the other one? Spare parts. Okay, so safety equipment, and then there was spare parts. Spare parts. Okay, so the safety equipment is going to be for 185,000. So remember the spare parts. They said 25% of spare parts are minor. So remember, spare parts could either be classified as PPE or as inventory. So generally, when spare parts have a useful life that is long, then you'll include it in PPE. When spare parts are minor and it will just be randomly used and consumed, then we will classify it as inventory. Okay, so you can see in this scenario, 25% of the spare parts are minor, such as valves and screws. So that generally gets consumed as we go along. So that will be classified as inventory because it's a consumable. But all the other spare parts is utilized over 6 years. So therefore, that will be classified as PPE. So all the spare parts of the 125,000, only 75% will be classified as PPE, because the other 25% is valves and screws, which is largely consumable, right? It doesn't, a valve doesn't necessarily last for 6 years. It is lost as and when you use it. Okay, so therefore, that 25% of screws, and remember, screws and can last forever and ever, basically. So we will classify those as consumables, and consumables is classified under PPE. I mean, under inventory. So therefore, over here, only 75% of spare parts is classified as PPE. So I'm going to say 125. You can just confirm if it is 125, but I know this is 75%, because 25% is consumable. So therefore, my total cost so far is going to be the sum. Okay. So remember, there's more stuff happening in the scenario, but for now, go plug in as is. Because remember, what they're going to mark is this. They're not going to mark your workings. So if there's nothing in here, you're going to get 0. So all we're going to do, we're going to go and we're going to plug it in. It's not, there may be more additions. There may be more additions, but so far, this is the one addition. Okay. So this is the one. There may be more additions. Is this working one? Yeah. So far, this is the one addition that we have. There may be more additions in over here, but one of them is at 5028. So therefore, we're going to go and plug it in. Okay, don't wait for your final answer. Don't wait till you have all your additions. Go plug in one at a time. Okay. Remember, there was no disposals in this scenario, so I'm just make it 0. In an exam, there's no need to include when something is 0. So there's no need to include this over here. Okay, then we had, okay, there was no other additions. Okay, so that was the big mark over there. Let me do some quick thing. Okay, so the borrowing costs, because we included borrowing costs in the cost of the item, we will leave it over there. So we're not going to include borrowing costs separately. If they were, so when you will, the question is, when will you include borrowing costs separately? You will include borrowing costs separately. So they may be, we want to include it separately. Maybe they want you to include it separately. Then you can. So what could have happened over here? Trying to think quickly. When would we include it separately? I can't think of an example, but you can have borrowing costs as a separate line item. Here we just include in the cost of the item, it is totally fine. But what's important to take note, if you don't have it in the cost of the item and you show it separately, you will have to add the two together in order to do depreciation. Because remember, when you depreciate an item, depreciation, the cost must include borrowing costs if you have borrowing costs and you want to calculate depreciation. So just be aware of that. Yeah, I can do the transfer. Okay, so this is the easy one. So remember, on 30th June 2018, on 30th June 2018, that is during the current financial year, property A went from investment property to PPE. Okay, so here, because it's only one transfer, we can say transfer from investment property. Okay, because only one transfer, we can say from investment properties. Okay, so property A on 30th June 2018 went from investment property to PPE. So on that date, because we investment property is measured in accordance with the fair value model, we will de-recognize investment property at fair value, and you will recognize PPE at fair value, because the fair value of investment property becomes the cost of PPE as at 30th June 2018. And we only do this because investment property was measured in terms of fair value model. So if you go to the scenario, under that note number 1, you would see as at 30th June 2018, the fair value for land was 1.7, and for buildings it was 2.4. Okay, so over here 1.7 and 2.4. Okay, so just take note of that. There's nothing over here, that's 0. Okay, there's nothing over there. So we're not going to have borrowing costs over here because we have borrowing costs included in the question, in the cost above.
Sorry to disturb again.
Yeah.
Sorry to disturb again. I just wanted to clarify the inspection cost of 60,000. Do we assume that that's included already in the in the 5 million?
Yes.
Oh, okay.
Yes. Okay. So I think I explained that in the first lessons. We must maybe watch that video, then you can see where I explain that, how I know it's included. Okay. So now all we have to do still over here is depreciation and impairment, and that's about it. Okay, there was no reversal of impairment in this scenario. Okay, there was no reversal because there's only impairment. Borrowing cost was included in the cost above, so there's nothing over here. So remember, wherever I'm showing 0, where every line is 0, like the way the whole row is 0, there's no need to include this in your exam. Okay, so just be aware of that. I'm just showing it for completeness purposes. Okay, I just want to finish off land before we go into buildings. So let's have a look. If you go to note number 1, and you see the table with property, you would see on 30th June 2018, land, the fair value of land was 1.7 and 2.4 for buildings. Okay. So why we use the fair value? Because it went from investment property to PPE. So before we de-recognize investment property, we need to account for those assets in terms of IAS 40. IAS 40, the company's policy for IAS 40 is fair value. So therefore, we first need to make the fair value adjustment before we de-recognize it from investment property and classify it as PPE. So that fair value amount becomes the cost price of PPE. So this is the cost price, the addition to PPE. We can't put it under the line item called addition because we didn't physically purchase it. It's just a transfer from one classification to another. We already had the asset. Okay, so that's important to take note. Then remember, now as at 30th June, as at 28th February 2019, we need to apply PPE for land. As at 28th February 2019, we need to apply PPE to building. So the PPE for land is based on the revaluation. PPE for building is based on cost. So therefore, we need to perform a revaluation on PPE, and we need to, cost means we need to do depreciation and impairment. So we need to find out if there was a revaluation on land as at 28 February 2019. So revaluation on land is in terms of IFRS, IFRS 13. So as you can see, they're giving us the following values relating to land were determined on 28 February 2019 in accordance with IFRS 13. So this is on page 8, just above inventory. Okay. So they're giving us two fair values. They're giving us fair value of use of land in combination with other assets, and we're using fair value of land on a standalone basis. Okay. So what's important to take note, we must use it always on a standalone basis. Okay, so we're going to use it on a standalone basis. So therefore, the fair value of land on a standalone basis is the 1.65, 1,650,000 Rand. So although the asset is actually used in combination with other assets, when we look at it from an IFRS 13 point of view, from a fair value point of view, we must look at it on a standalone basis. So the fair value on a standalone basis is 1.65, 1,650,000 Rand. So as you can see, when we transferred the land as at 30th June, it was 1.7. Now the fair value is 1,650,000 Rand. We must use the standalone basis. So you can see there's a decrease in the revaluation. Okay, so what we can do under revaluation loss, we will have 50,000 Rand. Okay, so we have 50,000 Rand. They kind of put it under impairment through, I don't think I would, let me just see if we can do like that. No, yeah, so you just take it against revaluation loss. Okay, so I'm not going to still have that over here. It doesn't, maybe they don't worry if you put it like that, but I'm not too familiar with something of that nature. So I don't use that line item. They use this line item. So I don't think they'll mark you wrong, but I'll just take it against a revaluation loss. Okay, so revaluation loss of 50,000 Rand. We cut there 1.7. We need to be at 1.650. So therefore is the 50,000 Rand revaluation loss. Okay, so that is land. There's not going to be a revaluation on buildings because we're not using the revaluation model. There's no revaluation on plant because we don't use the revaluation. So basically all that's left for us is depreciation and impairment. Okay, there won't be depreciation on land because we don't depreciate land, and there won't be impairment for what you call it, because we use the revaluation model. Okay, so what we will do over here, all we still need to work out are these two numbers. Okay, so I'm going to work out the number depreciation for I'm going to work out the depreciation for what I'm going to do now. I'm going to work out depreciation on land. I mean, on buildings. So we're going to go to working for. So they're using a cost model. Okay, so the cost model for depreciation, and I mean, they're using the straight line method for depreciation. So the straight line method for depreciation says it is cost less residual value gives me depreciable amount. Okay, gives me depreciable amount. Okay, depreciable amount less depreciable amount, and then we have a useful life. Depreciable amount divided by useful life will give me my annual depreciation. Okay, will give me depreciation. Okay, so give me depreciation. Okay, we will see what depreciation. Okay. Okay, so the cost price for the is 2.4 million. Okay, the residual value was given to us as, I cannot remember. The residual value was given to us as 280,000. So we would have costs minus residual value of what? Yeah, 280. The useful life was given to us as 20 years. So our annual depreciation is depreciable amount divided by useful life of 20 years. Okay, but remember we didn't have the asset for a full year. We only had it from 30th June. So that means and the asset, the building came into use on 30th of June. So therefore it is June, it is July, August, September, October, November, December, January, February. So we only had it for 8 months. Okay, only had it for 8 months in the current year. So this is going to be 1060 times 8 divided by 12. Okay, so my depreciation 8 divided by 12. Right. Yeah. Let's see, would be something. Okay. So 30th June, the useful life is. Should be something. Okay, so the useful life remained unchanged. Cost 20 years straight line. Okay, just the question now is what was the useful life? Yes, now it just doesn't see quickly when did we get this property? 1 March 2016. So 1 March 2016. So if we think about it, 1 March 2016 to 28 February 2017, that is 12 months, up until 1 March 2018, that is 24 months. It transferred on 30th of June, so that is 24, so that's 28 months. Okay, so just think about it like this. So I think we have to assume that this 20 years is not from 30th of June 2018, but rather from 1 March 2016. Okay, so from 1 March 2016, just read. Property A was a landable property is adjacent to the current property and was acquired on 1 March 2016. Yeah, I guess I don't know now. What do we assume? Carrying amount. Okay, I think we can only assume that it was 1 March 2016. So at the 30th June 2018, 28 months have passed. So 1 March, from 1 March 2016 and up until 30th June 2018, I think we have to assume that the useful life was from 1 March 2016. So therefore, because we are at 30th June 2018, how much time, how many years or how many months have passed? Basically 2 years and 4 months. So 2 years is 24 months. Then it is March, April, May, June, which is 4 months. So 28 months have passed. So I think over here, what is probably best to actually do is to not work on years, but to work on months. So this is going to be 20 times 12, which is 240 minus 28 months. How did I get 28 months over here? I'll do it now. So 240 minus 28. So the monthly depreciation is going to be monthly depreciation. So therefore, if we want 8 months, so now we're just going to multiply that by 8. Okay, so just take note. So it wasn't 100% clear to me, but I guess you have to make a call. So what I'm just assuming is that 20 years is the 20 years as from 1 March 2016. So we have the property now as PPE from 30th June 2018. So therefore, the remaining useful life. So the remaining useful life is the full 20 years minus the 2 years and 4 months that have already passed. Okay, so that's very important to remember. So remaining useful life. So therefore, this over here is, this over here is 80,000 Rand. So depreciation under buildings is 80, where am I now? Where's depreciation? Yeah, 80,000 Rand. So depreciation is decreases PP, so it is negative. And I'm going to tell them over here is working for. Okay, so that is that over there. Okay, now we must work out depreciation for PPE. Now we must work, for the plant. Now we must work out depreciation for the plant. So please be aware over here that you need to think about the component approach. Okay, so you have to think about the component approach. That's very important to take note. Now remember, the component approach, there are 3 aspects over here. Okay, so there are 3 aspects over here. Okay, so for the so there are 3 aspects when it comes to depreciation for the plant. Okay. So the 3 aspects for depreciation for the plant. So for depreciation of the plant, it's going to be the following. Okay. Depreciation of plant. It's going to be depreciation. Depreciation of inspection, and it's going to be depreciation of spare parts. Okay, so it's going to be total depreciation of plant. Okay, so you need to use the component approach. Okay, so it's very important to take note. You have to use the component approach. So that is what's going to that is what's going to happen over here. So that's going to be working 5. Now to get to working 5, we're going to have different numbers. Okay, so for example, I'm going to work out inspection. So that's going to be working 6. Okay, so for working 6, the inspection, cost of inspection, they told us the cost of inspection was estimated to be 60,000. We know the useful life is 2 years. Okay, they told us that useful life is 2 years. So annual depreciation. Annual depreciation is 30,000. So annual depreciation is that divided by 2, which is 30,000. Okay, but remember, when did the inspection happen? The inspection took place. When did the inspection take place? Where did I see that now? Okay, so inspection, we didn't talk about, okay, the plant requires inspection every 2 years. So remember now the inspection was estimated at 60,000. It happens every 2 years. So annually it's going to be 30,000, but the thing was only ready for use on 31 August. So therefore, 31 August, so that is, so it is September, October, November, December, January, February, so 6 months. Okay, so 6 months in current year. So therefore, we're going to say that multiplied by 6 divided by 12. Okay, so the inspection over there is 15. So the depreciation is 15,000 Rand for the current year. Okay, we're not going to finish this entire thing now because of time, but we will continue tomorrow. So there we go, equals 15,000. The spare parts, working 7. Okay, so working 7, the spare parts. So working 7, the spare parts. Remember, it was the 185 cost of spare parts. It is basically, we just go fetch the number above under working 1. It is going to be that plus that. Okay, so 278. We have it for 6 years. So it's going to be useful life. Which is 6 years. Okay, so let's just do that. Okay, but remember now for so the annual depreciation will be 46,458. But remember the spare parts was acquired on 1 August. Let's say these spare parts, okay, whatever, safety equipment spare parts, which is categorized as plant. Oh, so they told you spare parts and is categorized as plant. That is why it's important that you can include it over there. Okay, can be utilized for 6 years and it requires no special installation. So what we do over there with the spare parts, we simply, because we acquired it on 1 August, so therefore it's August, September, October, November, December, January, February. So it's for 7 months. Okay, so here it is 7 months. So we're just going to say 7 over 12. Okay, so there's 27,000. So all I'm going to do, I'm going to say equal to 27,000. So I want you for tomorrow to come with the calculation of the depreciation of the plant. And I'll give you a starting point. Okay, so the calculation of the plant. So working 8, the depreciation of a plant, the cost before cost before spare parts. Cost before spare parts, I calculated as 4750. Okay, then we're going to say less inspection, because remember the inspection cost is included in this amount. So we say minus 60,000 because we do the inspection separately. So therefore, over here, costs excluding inspection, okay, is the sum. So I'm going to stop here for tonight. We're going to continue to work out the depreciation for the plant, but if you can work it out when you, so you can have it ready when you join the class tomorrow, so that I can work through it quickly, and then we will complete impairment tomorrow. Okay, because I was going to be until 11, until 10:30. When we do impairment. So I'm going to stop here, and then tomorrow we will continue. Okay. But before we stop over here, is there any questions that you guys may have?
Yes.
Yes.
I just have one question. Now that we're running 2 days behind schedule, are we still gonna be writing the mock this weekend, or are we shifting the mock?
No, so remember what will happen is the class for FAC will end on Friday, and you will write the mock. And with the mock, when you write the mock, we will the feedback will help you through that. Okay, and like what Andile asked, so I do provide that. If you have specific questions that you want, and this is going to be open for all of you up until the exam. So although the CTA classes ends, or the program ends in 3 weeks, in that 2 weeks that you study on your own, I will have available time, like 15-30-minute slots if you want to, that you book with me, but obviously let me know before the time so that I can read through the scenario and stuff like that, where you can ask me specific questions. So on Friday, tomorrow is the last for FAC, and then you will write your mock, and through that we will work through any and through that you will through any specific feedback that you may have, that questions you may have, it will come through in the, I'll be able to pick it up through the mock, and also you will have an opportunity to have a one-on-one with me, like for 15-30 minutes at a time, to go through your mock exam. And also in your 2 week, when you study on your own, I'm going to have some available time slots where you can come on a one-on-one. And if I get a lot of the same questions, then I'll just have a group session. So that is basically how we're going to run with it.
So it means that we're no longer going to be doing Kelwood and Leicester together.
So, so you see, Leicester is a very quick question. So I'll cover that very quite quickly. Okay, because I think it's just a discussion question. Okay.
And Kelwood.
Yeah.
What about
I don't think we're going to get to Curlwood. Yeah. So what I do, if I don't get to a question, I do a recording on my own and I'll send it out. Does that answer your question?
I'm answered, but I'm not happy.
Sorry?
I'm answered, but I'm not happy, because I think the more you explain as we read through the question, for me, that is what helps me to better comprehend what I should be looking for when I'm reading the question.
Yeah, but if you get a recording of it, is that not good enough?
Okay, maybe it will help.
That's what I do. So you see, that is like one of the things that, one of the reasons why I don't actually give a schedule of a particular question that I cover, because of generally the approach that gets followed sometimes runs longer than anticipated. So when you put out the schedule, it is expected that every single question will be covered. The schedule doesn't necessarily mean every single question will be covered. That is what we intend to cover, but sometimes a topic goes much longer than anticipated. So, for example, if for me to actually have covered this 100-mark question and to cover Kerhood and to cover what's the other question, Leicester City, it meant I must run through the question the way you had to run through it in the exam. So then even if I covered all 3 questions, the level of depth wouldn't have been as this. You understand? So if you wanted that, then that means you're going to get mediocre of all 3 as opposed to a deeper one of, so you get what I'm trying to say, and that is the only reason why I sent out a schedule is because a few students asked for it. I should have made it clear perhaps that it is a possible or what we aim to do, but it does not mean all of those questions will be covered. That is what I attempt to do if we finish within the required time. But like in this case, this question was quite detailed. And if you wanted a detailed, the way as detailed we went through in this, question, the chance of actually getting to the other questions is quite slim. So, and that is a big reason why I avoid providing a schedule of particular questions. I just generally say 4 days, and so we're going to cover a particular thing, and then I cover it because I know I was a student, so I also know how out of thought I wanted all those questions to be covered. But if you want an in-depth, it becomes a little bit difficult to go in-depth and cover 3 big questions. The only way I could have done it is if I did basically 15 mark questions in a 90-minute session, 30 mark question, 20 mark questions of short scenarios, and then we'd have covered each, what you call it. Like, for example, like a Mac 3702 quick scenario or a test 1 quick scenario, and you just focused on that. Here we're having a 8-page scenario that is integrated across the entire question. So it took 1 day alone just to go through reading the entire, not even the entire scenario thoroughly. You understand? So that is basically that. But what I can do for you is that I'll then, if we don't finish, I'll record those videos like I'm doing it over here, or those questions, sorry, and then I can send it out. But that's kind of the best that I can do. Yeah. Any other questions? Other questions? But I hope that kind of explains, and I don't know what else I can do to make you more happy. You can just let me know.
Thank you so much, Faye. See you tomorrow.
Okay, pleasure. Okay, guys. Pleasure.